Good morning, everybody. Thanks for joining today, this fantastic day. And thanks, George, for your comments. Now I feel better because we know that value is going to work, and we are a value fund. But I'm going to attack value on a different way, a little bit different, what we call a strategic value. So what is value? Let's go to the beginning. What is value? Value is buying at a discount. That's easy. You buy something at a price which is below the intrinsic value. But this is getting more complicated. What is intrinsic value? That's not easy to calculate. And you know, even Warren and Charlie were saying that when they calculate the intrinsic value for a company, they get different results. So this is important. It's something that we have learned over the years. We've been there since 2002. We've seen 3 or 4 very deep crises, and we are learning. We keep learning. So the only way to value a company is, estimating the future cash flows and discounting them to the present value. So you need to build a kind of DCF. There's many ways to, many different models. But the DCF has some problems. Is many assumptions, discount rates, growth, margins, returns. And it is very, very sensible to these assumptions. So you can really get very different valuations with the same estimates. So it's not robust. And in the beginning, we were very value people. Like, we calculated intrinsic value, we found a discount, and then we buy. This is kind of where we started, 20 years ago. Quantitative, hard data. It is important. We still do it. But we moved, and we added another layer to value investing, what we call a strategic value, which is a quality layer or a strategic layer. So this is not new. We are 50 years late because Warren Buffett did more or less the same learning with Charlie, right? He started buying cigar butts, and now he's buying Coca-Cola and Wells Fargo and Apple, no, right? So he's moved from pure value to more qualitative or strategic value. So how do we start? Is it easy to start with the strategic value? We look for a very good track record long term. So this is important. You look at a company, you need track record. We don't buy IPOs. We don't buy stuff from private equities because you don't have enough track record. You can be misunderstanding the company. Sound market outlook. Somebody asked Charlie one time, I think Carlos commented to me, how do you value a company or a business that is declining? And he said, why do you dare valuing a business that is declining? Okay. So we try not to enter in a market which is declining or where the outlook is not clear, and we look for entry barriers. So to this process, we have put a kind of nickname that we call the 4 Gs, easy to understand, good business, so plenty of moats. This means a very solid strategic position, high entry barriers. And we gathered in 4 points these entry barriers. The first one would be intellectual property or brand intangibles. This is very important. Examples, Roche, with a lot of patents, or Grifols that we're going to show later on. Apple has an incredible know-how and entry barriers in software and also hardware. Aerospace, engines with Raytheon, for instance, in the US. So this would be the first entry barrier. If you have patents, IP, then nobody can come in and compete, or few people. Sustainable cost advantage would be the number 2. So if you find a company that has lower cost because of something, then it's a fantastic competitor, and people will not compete with them. Pandora, for us, is a cost advantage, the jewelry company, because they have a scale and they have a specialist LIBOR in Thailand, if I'm not wrong. Apple also has a cost advantage. Ivanhoe is a miner, copper miner. They have fantastic reserves at very low cost, very high grade. This is a competitive advantage. Third competitive advantage, switching cost. The normal example put by Warren is Gillette. So you have the razor, and then you need to buy the blade. But Microsoft is the same, and Apple is the same. So you have an Apple phone, then you buy the Apple computer, then it's going to be difficult to go out of Apple network. So this is a switching cost. This would be the third entry barrier. And finally, the network effect that now is very well known because of all the social media, right? But Visa has a great network effect. Even Google are perfect examples. There are other entry barriers, oligopolies. Supply is in some segments constrained, and we look for companies there, companies where they cannot be attacked easily by competitors. So this is, what we call good business, good management. It is easy to say, and it looks very simple. It's not easy. You need really to focus on the management, try to understand them, and good managers, they have positive options. They do the great M&A, they do what they should do, they focus on returns, corporate governance, shareholders, minorities, etc. And the bad managers, we had very bad experience here. More in the natural resources space where we move for a long time, you have managers that are really, really bad guys, and they can kill the company, even good companies. Here we disagree a little bit with Warren that says that he buys companies that can be run by a monkey. If you put a monkey running Coca-Cola, Coca-Cola will go down. So we really, really, and it's really tough not to buy the company. You find the company is fantastic, you want to buy it, it is cheap, and then you have a bad guy there, and you say, why? I'm not going to buy this. No, it's a red flag. And we try to be disciplined. Same with the balance sheet. Again, something that looks easy, but it's not that easy to execute. You need to understand the balance sheet. Gearing can lead you to permanent loss, which is what we need to escape from. A permanent loss is a real loss, as Warren puts. And volatility is different. I mean, prices go up, go down on whatever mood you have, but permanent loss is a permanent loss, and we are very concentrated. We have only 30 to 35 stocks, and we cannot really lose money in any of our investments, so balance sheet is very important. And another comment very fast here, a bad balance sheet, a gear balance sheet is normally a red flag and a symptom that something is going wrong. Maybe cash flow generation, maybe accounting, and maybe some trickiness from the management, but if you have a gear balance sheet, you need to look for why this is happening, and sometimes they hide it. So it takes years and years to understand why a company and why the debt is this or that. And even now, I get some factoring surprises or confirming surprises, or you have debt in this associate that you wouldn't take into account, or a loan which has a preferred dividend. So you really have nasty things out there. It's very important. It takes a lot of time to understand. And then again, you need to be very disciplined, because you find a fantastic company that it is geared at a PE of 2, and it's very tough that you don't buy it. You say, OK, let's go to the next one. So summary, the 4 Gs, we analyze the sector, which takes time and years. We analyze the company, strategic position. We choose good companies overall, and we buy them at a discount, so it's easy. We try to apply these learnings to the portfolio construction, and we have 2 entry barriers, so learning from the real world. We have first entry barrier. We have a matrix of good sectors and bad sectors, sectors that have generated return over cost of capital over the years, and these we like them. I don't know. We have salmon, we have software, we have engines, aerospace engines, we have online payments, we have many, many sectors and subsectors. And then we have a watch list. We only follow 250, 300 stocks that are in the watch list. If there is a new idea, then never goes to the fund. So it's an entry barrier. There's a new idea, it goes to the, then filter the sector. Is it a good sector or not? For us, for instance, there are sectors that we cannot really invest them. One would be autos, although we can discuss this, because within autos you can make a lot of money in some of the names, in our opinion. And then, this watch list is an entry barrier that help us not to follow the crowd. Ooh, NVIDIA is up and AI is fantastic. It's going up 30%. Let's buy. No. Is it a good sector? Yes or no? Let's go to watch list and then see sub-quarterlies take time. So I was adding some spice from Warren here to make it this a little more with more sound. The single most important decision is in evaluating a business is pricing power. This is exactly what we try to say is when you have high entry barriers, you have pricing power. You can raise prices. Whatever happens, you can raise it. It's not an obligation that you raise prices every year, but it's exactly this. When you have high moat, high entry barrier, you have entry prices. Time is friend of the wonderful business. When you have a portfolio which is good quality, there's a recession, who cares? There is a slowdown, you can just buy on the cheap because you have good quality, you can buy cheaper and just wait. When you have a low quality portfolio, then it becomes a bit more complicated, in our opinion. Value works, so it's a little bit repeating what George was saying, but I will go fast here. Value is up 8 to 9% since 1975 because we did just the index, the MSCI value. Very easy. That's empiric, no discussion. The equities long-term global do 6-7% per year. So our numbers are very much in line with what George was saying. The same chart from Fama and French. Here it's value beats growth, so no more comments. Long-term value beats growth, and since 1945 you can see this growth, which you can, I don't know, put a number, 2-3%. And I found this in internet, so it's not our chart. Sorry for that, but I look at the chart, and it was a fantastic one. And this is the summary of what we were discussing here, because the last cycle, in red, you have the growth cycle, so when growth beats value. And in blue, you have the value cycles. The last one has been really, really amazing, more than 12 years. And to the question, it is basically due to the low rates and huge liquidity. This has hidden everything. Every business model works. You have a business, a new business, you have plenty of cash, venture capital, private equity. This has been party time. And in our opinion, the party time is over. It was over in 22. Now it's hovering around, but this is going to take many years. So we agree with BWM that now the new value cycle has started. So now it's perfect timing. You have the value cycle starting in 22, and long term, we outperform. So let's go for some drinks. That's our fund. It's a coincidence that we have a name similar to the BWM guys. So our fund is a value global. The name is LTF Classic. In 2011, over the learning of the global financial crisis in 2008 and 2009 and 10, we had a very bad experience there, and we thought a long time how to improve the performance. And then we added the 4 categories strategy. We divided the fund in 4 risk categories. Categories 1 would be low risk, a basket of Nestlé's, McDonald's, Coca-Cola's, whatever you find, Viscofan, Devro. We don't really care about large caps or small caps. Our universe goes everywhere. We look for sound businesses, and we ask for a 10% return for the category 1. Category 1 and 2, the 2 would be also very, very high quality assets. 3 would be cyclicals, and 4 high risk. And the fund normally is 50-50. But we can play with that. And we did it in March 2020, where the market collapsed. And then we moved aggressively from 1 and 2s that fall much less when the market falls, and invested heavily in categories 3 and 4, including natural resources that are high beta. This is why the performance, basically our performance is very similar to the value. It's amazing that we have many different stocks. And you look at the value guys, and we all of us made more or less the same return over the long term. And we have good phases, bad phases. But we made a killing because in the last, since 2020, because we rebalanced the portfolio, we moved to high risk because high risk was completely rated. And this is why the fund now looks a bit just marginally better, although long-term 2 points of difference is large. So Tweedy Brown in the US, Warburg Value, Bestinver in Spain, and then DJE, some of the well-known guys in Europe. I want to talk a bit on risk, because a lot of investors and people talk us. Well, how do you control this risk? And our risk is not really Vola or statistical or VAR or Sortino or Sharp, and we strongly say that this is not really the way to control risk, in our opinion. So for us, it's good quality. When you have a good quality company, your risk is much lower. We focus on what we understand, circle of competence, and we really do heavy weighting like we did in March 2020. So now, for instance, we have several stocks with 6-7% weighting. So we really focus in what we understand, and we are concentrated in the same time. And we are also diversifying. And sorry, it looks a contradiction, but it is not. This is 42% of the classic in 10 names. You can see half of the fund. So basically, I don't need to spend too much time talking. You have the 10 companies that are more or less half of the fund, right? Grifols, Protein Plasma, Sodexo, Catering, ISS, Cleaning, Heidelberg Cement, Unilever, Food, Beverage, Cleaning Products, Medtronic, pacemakers and devices for operations and blah, blah. Pandora, Jewelry, Leroy, Salmon, ING Banks, Reckitt Beckkinser, again, consumer products. You have, more sectors than companies, which means that nothing can kill us. China goes wrong, we will suffer, but it's not killing us. So we focus on this, quality, focus, and concentration and diversification also, not to get killed by only one trend. So it's very defensive. The second way to attack risk is numbers, numbers, numbers. We do valuation. We do a lot of valuation. We have an IRR and an intrinsic value for every company. So we have an IRR and an intrinsic value for the fund. We assign risk categories, as we commented, categories 1, 2, 3, 4, and the fund is balanced. We also assign ESG categories because we understand that ESG is going to be increasingly important. We are not an ESG fund, but we care about ESG. And you know what we find, that ESG categories are very much aligned with good managers. So I often find the same, rating, good management, good ESG strategy, and we don't trade too much, we don't hedge, we don't do timing. I mean, we just buy when it is cheap and sell with its intrinsic value or more. Even when it is intrinsic value, we have an IRR. So if Nestlé reaches your intrinsic value, which is calculated at a 10% return, you may say, wow, 10% Nestlé, the 10% return for Nestlé is not bad. I keep a 1% in the fund. So, it's dynamic. We don't use Sharpe and Sortinos because they are based on volatility, and volatility for us is not really a measure of risk, and real risk cannot really be measured. And the third approach is value, value, value. This is pure value. We buy on the cheap. The P of the fund is 10 times. Price to book is 1.6 versus the market 2.4. The market P is 15, so we have 5 points, 1/3, which is basically we look for 30% discount, and this again is a protection. If you have a quality asset, even a quality building, you buy it at a 30% discount, you are really, really protected. You can have volatility, prices go down, but the asset is fantastic. You look long term, you have your building is high quality, and the market will be back. And some more lessons from Warren. Risks comes from not knowing what you're doing. So risk is, you may invest in a utility company thinking it's low beta is super safe, fantastic business, and then the next day the government puts a new tax, 50%. This has happened to us in salmon. We had salmon, and the government from one day to the other put a 40% new tax on top of the 25. So this is risk. You can tell me that you didn't know that. Well, we didn't know that, and it's what is trying to say. But sometimes you have these things, so you need to be ready to fight for that. Luckily, we were underweighted the sector at that moment. But if we would have been very overweight, you can be killed, and this you need to manage on different ways. Volatility is not risk, so this is more or less the same we were discussing. But the sentence is so good that I cannot escape. A wildly fluctuating market means that irrationally low prices will be periodically attached to solid businesses. It's impossible to do a better summary than this. Sometimes, the market gets crazy and puts huge valuations on the upside and huge valuations on the downside. And is what we did in March 2020, and is what we will try to do now if there is a recession. Now everybody is, a recession is coming. Market is going to go down. What we are doing is we have a little bit of cash. We are more in categories 1 and 2 and just waiting. If the market goes down, we will heavily invest what we have in cash, move to 3 and 4s, and then the next 3-4 years. So automatically, the IRR of the fund and the intrinsic value of the fund will move up because you will buy things that have fallen much more than the others. And this is helping us to control a little bit the recession fear. And then a question to you all: what do you want? Our fund to go down or our fund to go up? Because if the fund goes down in the next 12 months, the future will be much brighter. The only problem we have, as George was commenting, is that people feel fear when they see the net asset value going down, and some of you or some of the investors will leave. But I think that all these meetings that we're having help people to understand that when the market goes down, we are going to make much more money. 3 examples of, to put a little bit more of grain here. Devro, we presented it last year, right? Yeah, we presented it last year. And this company was a small cap, lost for everybody in the trading in the UK, but the business was fantastic, strategic value. They do the casings for the sausages, so the thin film that goes in the sausage, or chorizo. And the return on equity, more than 20%, dividend yield more than 5%, the market grows 3-4%, and it's an oligopolistic market. There is like 4 or 5 companies in the world, and 2 of them have more than 1/3 of market share. All the management are disciplined, so pricing power, they don't fight for contracts. And it's a market that we know for decades. We had it and we got a bid. And again, it's what George was commenting. I mean, nobody was really taking care of this, a small CAC, UK, recession, whatever, and then we got a bid exactly or very close to our intrinsic value because it's easy to value. I mean, the business is so solid that the growth is the same and the margin is the same and the return is the same. You don't need to be here a rocket scientist. Butzi, I think we share this investment with BWM. It's a cement company. It's a good business. The return on equity is 10%, which is good enough. Look at the valuation, 0.8 price to book, price earnings 9, return for us is 14% now at the current prices, intrinsic value 28. So, and the stock is trading, I think, 22. So there's still a good upside. We like it more. Why strategic? So initially, cement is an oligopolistic business, but it's multi-local, right? So normally you have a city, they're building things, and they need 2 or 3 cement companies around. And cement is so big that it doesn't travel well, which means that you have mini oligopolies that sometimes get crushed because of recessions or because there's another incomer to the market. But in the end, you know, it's a good business. Once you have done the investment, which is massive, you have 100 years to make cash flow and a lot of free cash flow, right? So because you don't need really to invest that much. But there's another thing that we didn't expect here. Sometimes value has good options, which is that now with the CO2 schemes in Europe, these guys, cement, I think it's 8 to 10% of CO2 emissions worldwide. And now they need to invest a lot in carbon, in just machines that they put in the furnaces in order to capture the CO2, and then they need to invest in CCS systems, so big investments in order to capture the CO2, and only the big guys will do that. Which means that there's a marginal part of the sector in Europe that will not be able to operate because they don't have the means to make these huge investments. This means less capacity. And then the CBAM, cross-border tax adjustment now that has been approved by the European Union is going to prevent imports because most of the imports are from companies that do not do the CO2 effort, which in the end, less imports, less capacity in Europe, you restrain capacity, demand is the same, prices will go up. So maybe, and this is one of the ways to make tons of money, is if you find a sector that is changing the regime. You find a sector that historically has made 8 to 10% return on capital employed, and is going to make in the future 12 to 14, you will have a huge re-rating. And this we found a couple of them. Salmon was one of them, and UK house builders was a bit different. Finally, an oil company very fast, because you know very well that we think that the energy prices will move up on the lack of investment. So here we have a kind of sector call. Lack of investment in oil will means that you know, we have a depletion. We lose 4% every year, 4% of the production. We eat it. We deplete the fields. We are not investing, and then nobody wants to invest. Why nobody wants to invest? Because ESG problems, and because everybody is convinced that we will not need oil in a few years. So, you know, you don't buy oil because in 3 years you will not need oil. And this is preventing CapEx to go to an industry that needs a lot of CapEx because of depletion. You not really need demand to go up 5% per year. Every year you consume 3 to 4% of what you have. And this is going to end up in tears, in our view. A couple of comments from Mr. Buffett. Well, this is Ben Graham, I think, in the origin. The market short-term is a voting machine, and this is back to what George was saying. Short-term, this is really crazy. So don't call me on short-term things because I don't know. But long-term is a waiting machine, and we have quality, we have discount. I mean, there's no way, and we have diversification, there's no way that value with BWM and us will not do what we've been doing for the last 20 years. And the same message here, do not hold a share for 10 minutes if you don't want to have it for 10 years. So long-term, long-term, long-term. Give me 2 minutes? 5, good. That's our biggest stake. I'm going to try to explain a little bit the fundamentals of Grifols. We have 6 to 7% in our fund, so it's our biggest stake now. It's a complicated business. And it is the business case that we're going to do later on, after the break. We will have the company presenting the case. So I wanted to introduce a little bit what is Grifols to help you to understand what the company says, and then maybe do some interesting Q&A. Global player. So this is a plasma protein company. So they have donors that they donate the blood. They take the blood, and with a process that is called fractionation, they bring out proteins. So they separate the plasma, and they take out proteins from the blood. These human proteins have some effects that they are using. So they take these proteins and they build products, the pharma products that are licensed. They need a license from the FDA in the US and from the European authorities, and they sell these products. So they are integrated. They have donor centers, they have the fractionation facilities, and they have the products, the pharma products licensed. Actually, I think they even invented, the grandfather of the CEO, or the ex-CEO, is the guy that invented the fractionation. So it's a really a cool company. 22 million liters of fractionation capacity, 6 billion sales, 1.2, 1.3 billion EBITDA this year, a bit lower than the figure. Well, we'll see. Vertically integrated, and they have 4 divisions. The main proteins are immunoglobulin, albumin, alpha-1, and factor VIII that I'm going to describe very briefly. So immunoglobulin, basically, it's a kind of help for the immune system. So it tackles immune problems that people may have, and it works as an antibody. And this is probably the product that is 50% of their sales, if I'm not wrong. So it's the biggest product, but it is not the one that brings the higher margin. Albumin is basically blood pressure and also transport of several products. And it's used, I think, when you go to the hospital and you have, you get operated, then they use it in order to facilitate the pressure and some transport. So it's very used in hospitals. Alpha-1 is a protein that tackles genetic disease. So if you have a lack of this protein on natural genetics, then you have pulmonary diseases or lung diseases, and you need this protein. And this is an illness that is relatively new, is not well understood. So you have people suffering this that they don't even know. And this is growing a lot in the US and trying to be exported to Europe and then to emerging markets. Factor VIII, you know it better. It's well known. It's for hemophilia. So it's Alpha-1 is probably 40% of their business because they have market share of 70%, 70. Try to bring somebody to compete with them in Alpha-1. It's impossible. You need the donor centers, you need the fractionation, you need the patent. It's impossible. And then this is why I'm going to, well, it's then I will elaborate a bit more on this. They have a global footprint. On memory, more or less 50% of the business is in the US. Why? Because in the US, donors can donate through a payment. You can pay them, and they donate blood. In Europe, is different regulations, but normally it's not allowed to be paid for donating blood. This is why the US business is more developed, and they have a better presence there. So more or less it's 50%, but Europe is changing. There's new regulation because the protein market is doing very good, no, in terms of health. Global presence in most of the countries, even in China. 100 countries and subsidiaries in more than 30. Why do we like the sector? It's very easy. And this relates with the entry barriers. Intellectual property. Massive. Here you have everything from fractionation to know-how, how to take the blood from the people on a, there's a lot of know-how in the process, and then you have the patents because they have the pharma products with the proteins that are patented. So, there's IP, you need the licenses, which is another entry barrier. It's an oligopoly. Of course, it's an oligopoly because, it takes decades to get there. And there's 3 or 4 people in the world, and all of them make good money, and they are disciplined. Also, investments take a long time. This is why when they need to open a new plant, they need to think about the supply demand over 10 years because it takes many, many years to get the license, to build the fractionation capacity and all the network. Basically, you have a new fab, which is empty 5 years after, and then you need to fill it. So really, you need to be very sure about the demand supply, which is very good. And the 3 companies that are leading the world, Takeda from Japan, CSL from Australia, and Grifols, they have very clear. And then they have obviously switching costs. I mean, you cannot, if you take Grifols product, you will not change because you get used and the doctor will give you the same product the next time, unless there's a big innovation, but it's going to be difficult. Will AgriFols fast growth, 7-8% per year in the protein world, vertically integrated. The company was small 10 years ago. We've been living with them. Now it's a top guy. They've made mistakes with that. We'll go there. On our convergence means we trying to understand what is the EBITDA that this guy should make and return they should make. It's an EBITDA of 30%, return on invested capital after tax of 15. So this is on our numbers. The company now has faced fundamental challenges and cyclical challenges, and the share price is down 70%. So yeah, management issues. It's a family that runs the company, or used to, too acquisitive, balance sheet going up in terms of debt, not really transparent, accounting is a mess. And then cyclical challenges, because with the COVID-19, they couldn't really extract blood or plasma, and they had a problem with inventories and with the price of this plasma. So on cyclical challenges, they had very tough 21 and 22 and maybe 23 with a gear balance sheet. Now, when you have problems, you understand what the gear balance sheet means. That's the share price. So very good performance historically. And when the problems started in 2019, I think, went down 70%. They are doing a lot of things. I'm not going to talk about that because the management will do, but there are changes and very important changes that we can comment later with the company. And just to say that the valuation is really attractive. P, we have the preferred share, which is on 6 times. On our numbers for 2025, I think, or 25, 8 times for the normal business, 6 times for the preferred. Normalized cash flow on our numbers, 12%. So, 12% plus 8% growth, you make a killing. So that's for AgriFols. I hope you more or less are prepared for the Q&A then with the company. And that's us. The only message here is we invest in the companies as long-term partners with us, and we are looking for investors as long-term partners with us. For the next 20, 25 years, we don't trade, we don't do short-term stuff.